Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Today I will present for our conference. I will present my concept paper together with my friends. Myself as the first author. So we proceed to the slide. Okay. Okay, this is my slide. Okay. So today I will present about my concept paper. The title is The Effect of Money Creation in Increasing Demand and Generating the Economy. First of all, I will introduce myself. My name is Farah Nadirah binti Abdul Manan as the main author, as the first author. Okay, we are from Universiti Islam Antarabangsa Sultan Abdul Halim Shah, UniSHAMS. UniSHAMS located at Kuala Kedah, Kedah, Malaysia. Okay, so I'm so glad to present today of my concept paper, simple concept paper, and I hope my presentation will give a benefit and knowledge to all of you. And then, so we proceed. Okay. My presentation is for second Kuala Lumpur International Conference on Social Sciences, Education and Engineering 2021. So we proceed to the first slide. Okay, this is the introduction. So basically, this is concept paper. The main methodology that I will use is using qualitative by interviewing and then referring to the previous literature reviews, previous study and all that. Okay, so the introduction. Money creation is an issue that is often raised and associated with the country, banking institution and economic growth or development. So when we talk about money creation, we'll imagine about money supply. When money supply, we'll imagine about bank. And then about bank, we imagine about the economy. So, in the money creation process, there are two parties that, importantly, they are very important. They are very have a huge responsibility in the money creation process, which is the bank, uh, the central bank, and then also the government. Okay. So money creation is also influenced by money spending pattern as well as money lending patterns by household and company. So we, us as the household, is also will influence the how money creation will become. Our household, us household, and then the company that usually make loan for their business, and then the entrepreneur make a loan for their business. So all of us are the users of the money will influence the money creation process. Okay, banks are constrained on how much they can lend if they are in competitive banking environment to stay profitable. So bank, they have their reserve requirement, which means that all the money they cannot simply giving loans. So they have to reserve some. And then the rest they will produce loan, will offer loan to us. Okay, monetary policy act as the ultimate limit on money creation. So who are controlling the monetary policy? The monetary policy will be controlled by the central bank. So the central bank aims to make sure the amount of money creation in the economy is consistent with low and stable inflation. As long as the inflation is stable, so there is the money creation. There is the money. And then if the supply of money decrease or increase, so the government and also the central bank will take the action in order to make it stabilize. Okay, money creation and its current issues. Okay, I'm referring to the previous literature review, previous study. So the government and the central bank are two arms of the state that are responsible for economic management. So, like I said before, so the government and the central bank, so they are very important in the process to make sure that the economy are at the stable situation. So Arman 2011, they are both part of the state and are the key entity whose relationship and mode of interaction is the underlying equation that support money printing and creation. So according to Mackley et al. 2014, there are two misconceptions about money creation. One common misconception is that banks are merely functioning as intermediaries, lending out the deposit they save. Another common misconception is that by the regulation of the volume of central bank capital, the so-called money multiplier approach. Okay, so we go, and then in order so the money multiplier is the process. Usually the bank, for example, the bank uh, supply the money, for example, giving loans. So the A person will take the loan and then the loan they will deposit to another bank. So the money will become money multiplier approach. So the central bank decide the amount of loan and deposit in the bank, in the economy. So Delady and Levrero 2017 found out that United States Bank loan determine bank deposit and also the bank deposit determine the monetary base. They concluded that the lending activity of commercial banks determine the money supply primarily endogenously. So for example, in case the demand of money increase, so the commercial bank will supply more money. Okay. Money creation from banking perspective. In general, banks create deposit that pay no or low interest in order to make loan. So, okay, bear in your mind, the bank is only the intermediaries. So, for example, bank have 100,000. So, portion of the 100,000 they will reserve, and then they will give deposit. They will give as a loan. Okay, and then usually the bank charge for the loan is higher than the deposit. So because they want to make profit. In case the customer A just put the money in the bank and then the bank have to pay the interest because of the putting in money deposit. So comparing to giving a loan, they will charge higher interest rate. So this is how bank making profit. So usually they will charge higher rate for the loan rather than for the depositing in the money. And because when some deposit the money, so they have to give the interest because you deposit the money in their bank. But if you giving loan to this person, so this person are owing you. So owing you as a bank. So bank can charge high interest. This is how the bank make a profit. Increase their money supply. Okay, Wikipedia 2021. The process of money creation occur when commercial bank lend money, which increases the amount of bank deposit. The banking system can grow a country money supply beyond the quantity issued or targeted by the central bank, creating the majority of broad money via a process known as the multiplier effect. This is how I explained before. Huh? So this is how the money circulation, the money move from one bank A to bank B. This is how it happened. So Lee, according to Lee 2021, evidence from the model and the data that suggests that the dramatic changes in the money multiplier after 2008 are mainly driven by the introduction of the interest on reserve with the low nominal interest. Right. Okay. And then John Novick et al. 2017, they found that after the post-crisis, there was a significant positive relationship between the money multiplier and the risk-free rate. They found that the higher is the rate of remunerated reserve, the more significant that rise in the multiplier may be. Besides that, they also found that the money multiplier is positively related to stock returns and negatively to stock volatility. So deposit are created during the loan making process. It's what I told before. So a loan is credited to the borrower account. Okay, continue. Okay, Botos 2016 question the role of commercial bank. Either it's actually create money or simply mediate money, become the intermediaries. Usually the responsibility of creating money is come from central bank. Commercial bank act as the intermediaries. Okay, Gupsky and Tarafas 1977 describe very clearly how in general created money came to appear in the banking system by means of promissory notes. Promissory notes being debt securities which banks consider worthy of discounting were discounted by the central bank. A promissory note embody a payment commitment by debtor. Okay, money creation from economic perspective. So money are measured and categorized as M0, M1, and M2. Okay, M0 refers to the physical ringgit Malaysian notes and coins circulated in the economy. M1 consists of M0 and demand deposit. M2 refers to M1 plus saving deposit, fixed deposit, negotiable instrument of deposit, repurchase agreements, and foreign currency deposit, while M3 equal M2 and deposit in other banking institution. This is the definition according to Bank Negara Malaysia website. So according to Investopedia 2021, central banks oversee the money supply and interest rate as part of monetary policy. So monetary policy will be controlled by central bank. To booster a sagging economy, the central bank will lower interest rate. So when they lower interest rate, so borrowing become easy. Borrowing become more cheaper. So making borrowing more affordable while expanding the money supply. If the economy expands too quickly, means that there are a lot of money supply. So what the bank do is, if the economy expands too quickly, the central bank can tighten monetary policy by raising interest rate and withdrawing money from the circulation. So at this time, the borrowing process it become harder. The interest rate is higher. So people tend to save more than spending. Okay. Okay, Tegene 2021. Over the period 2002 to 2017, an increase in the growth rate of broad money supply has a beneficial impact on Ethiopia real GDP growth rate. However, real GDP does not cause broader money supply. According to Bonsi et al. 2019, increase in money supply that has no real asset backing, for example, fiat money, is disconnected to the real economic growth because fiat money has no real asset backing, the lack of real economic productivity investment opportunities, and capital misallocation that leads to speculative investment. An increase in money supply will lower the value of money already in circulation and or raise the price of goods and services above what it was before the increase. So according to Bottas 2016, money from the central bank is also required to meet the central bank mandated reserve requirement. This is what I told before. Not all the money they can simply give in loan. So as a result, there is a link between central bank money creation and commercial bank money creation. So according to Bottas also 2016, there are two limitations of money creation by commercial bank. The first is the limitation are the loan demand in the real economy. How about the situation? How about the demanding from the loan for the loan? And then the second is and the regulation, such as banking supervision requirement. So for example, commercial bank have to fulfill the requirement that state by the central bank. Okay, Good How 2017, the terms and conditions on which overdraft or credit card lines and limits are set are negotiated heavily by banks. This is the limitation of banking system ability to create money. Okay. So we look at important role for central bank policy in ensuring that credit and money growth are consistent with monetary and financial stability in the economy. Okay, the main is mostly the slide will be explaining about the responsibility of the central bank. So in Malaysia, we have our central bank named Bank Negara Malaysia. So main roles of central bank is to promote monetary and financial stability. So the monetary policy stand of Bank Negara Malaysia seeks to preserve price stability while supporting growth. The Bank Negara Malaysia is also in charge of maintaining the financial system stability. This is accomplished through create a sound, robust, progressive, and diverse financial sector to support the real economic sectors. It also aids in the implementation of policies aimed at deepening and strengthening financial markets, especially the foreign exchange market. Bank Negara Malaysia serves as the government banker and consultant on macroeconomic policy and public debt management. So Bank Negara Malaysia is also the single entity that charged of issuing the Malaysia ringgit and managing the country international reserve. So now we look at the effect of money creation towards economic performance. So we look at the first situation when the supply of money goes up. Means that there are a lot of money supplied in the economic circulation. So when the supply of money goes up, the cost of borrowing will be low. So it is easier for us to make a loan. So what will happen? So the borrowing of money become easier. When the borrowing money become easier, so all of us having a lot of money. When we have a lot of money, so we have to spend. We love to spend. We would like to spend. So when you spend, so the consumption rate will be increased, and then lending tend to go up and makes the inflation rate increase. Means that the price of goods and services also increase because a lot of us has having a lot of money. So, in order to stabilize the economy, the government will implement fiscal policy. Bear in your mind, the government will control the fiscal policy and the central bank monitor the policy. So, in order to stabilize the economy, the government will implement fiscal policy which are increasing tax and cutting the spending. So, when the price and the goods become more expensive, so you stop the eager to spend. So you tend to save. So and then you will cut your spending. And finally, at the same time, the central bank also do their responsibility, do their action, do their roles. So at the same time, the central bank also will implement a tight monetary policy by raising interest rate and removing money from circulation. So the economy, the crisis becomes stabilized. So effect of money creation to economic development when there are decrease in money supply. So this situation happen when there are decrease in money supply. So what will happen when there are less or decrease in money supply will cause an increase in average interest rate in an economy. Decrease in money supply will make the consumption power and borrowing tendency become low because this is too hard. When you want to borrow, bank also they don't have money. They don't have money supply. So what will they do? They will increase the rate. So make your tendency to borrow become harder. You cannot afford to borrow. Huh? You cannot afford to borrow. If you want to borrow, the interest so high. So this is decrease in money supply will make the consumption power and borrowing tendency become low. So you do have money, you don't have the purchasing power. So you save more money. Huh? If you want to spend, you don't have money. So people will prefer to save than spend. Okay. So in order to boost a sagging economy, so when purchasing power drop, so the economy cannot move. Because of that, so the central bank will lower interest rate, so will making borrowing more affordable. So the rate of borrowing, the interest rate of borrowing become lower, so you tendency to borrow increase, making borrowing more affordable. You afford to make a loan, to make financing. So what expanding the money supply. So when you afford to make loan, to make financing, you have a lot of money. When you have a lot of money, you tend to spend. When you tend to spend, so expand the money supply in the economy. At the same time, the government also take the action. While the government will implement fiscal policy by decreasing the tax rate. So in order to encourage people to spend, in order to make sure that the economy, that the money circulate in the economy, so the government will increase the tax rate while raising the spending to boost the economy back. Okay, that's all. So thank you so much. Assalamualaikum, and I hope my presentation will give a benefit to us, will give knowledge, and that's all. So thank you. Assalamualaikum.